All right, we should be rocking here. Let me see if this is going up properly. Open. There we go. Sorry about that, guys. A couple minutes late. Having an issue. We're pushing on Zoom and also wanted to share over here on YouTube. So we apologize for the delay, but we are up and running here. So let's go ahead and get started. It is Monday, November the 3rd. Uh, Currently 8:08 Central. We got about 22 minutes till the market opens and setting the gap up just a little bit here on this positive news involving Trump and China coming to some terms there. So the general structure of the market has remained the same, right? We get big bad news, market tears down on it, Trump makes peace, it rises in anticipation, little blow off top from it, and then he repeats this process. And so we've been doing this for the last several months. Wall Street has named this the taco trade, which stands for Trump always chickens out. And just really a reflection of, basically the market moving on fear-based news, them then realizing it is not as bad as they thought, and the market coming back. And obviously the tariff situation that happened in February and March was a big exaggeration of that. And we've come ripping back in what has been one of the strongest 6 to 7 month rallies in Wall Street history. So, where's the money flowing today? I am going to look at the areas showing the greatest amount of strength this morning. We are seeing a lot of strength coming into the biotech space. This is new. It's beginning to rise up the ranks, showing strength there. Biotech is a bit of a tough one since there are more than 700 different biotechnology stocks. So unlike quantum computing, where we can pull the 7 or 8 top names, or semiconductors or clean energy or nuclear, where there's generally 5, 10, 15 clear leading stocks in that group, biotech's much bigger. So there is going to be a lot more opportunity there, but you do want to filter it down because a lot of those are little micro and small cap stocks trading at, less than $1 a share with minimal volume, and that's just not places institutions are flowing. They're going to be going into those big, large, and to mega cap stocks. Now, we also continue to see strength in the nuclear space, and if you guys got my email on Friday, one thing one stock that I was talking about was one of these quantum stocks called Regetti. And I actually took a little mini position in this. And I was talking about the concept of fractals, okay? And fractals to me are a really important concept of the market. And all they are, fractals simply say that you are looking for similar patterns on different time frames. Okay, so for example, like this is one of my favorite breakout patterns we see in a stock. And you can see it again over in here. We'll see it off the lows, we'll see it up at the highs. And it's when a stock makes a decent size rise, in this case about 90%, and then comes in and begins to shallow and tighten up and form this sort of, I call it a shallowing pattern. Sometimes it forms a bit of this wedge, but what you're seeing is the action kind of compressing, and you're seeing these swings tighten up and tighten up and tighten up, kind of like a coil spring. And what's happening when this takes place is that the market is absorbing the supply of that stock. And, you've got some big buyers, big sellers out there. You've got to work through all that selling before the stock is capable of rising. Okay, you got a stock from 10 to 15 to $20 a share. There's going to be some people selling in there. And so what you want is for these little pullbacks, these profit taking to shrink up. So this goes from like 23%. This one is still pretty big at about 23% as well. But then this next one got a little shallower at like 15%. This last little tightening you can see here is about a 6 or 7% range. And then when it broke out, it went on this nice big tear higher from, call it 17, $18 a share to $58 a share. It's a massive, massive run. But when things really line up, and the best trades tend to be these areas where it lines up on multiple time frames, okay? And why did that gap down happen? I hope you're not talking about the 0.5% it's down, because that's just kind of a rounding error there. It's part of it. When we look at something big, like if we look at gold, and the reason I was so bullish on this a year and a half ago, back in here in early 2024, is this is a perfect example of fractals. If we go in here on a daily chart, we're just going to go back in time, back over in here. Okay. You can see that pattern forming, right? This is kind of it was shallowing and also kind of drawing down, but notice how this pullback's got a little shallower. Still wiggling and then nice and tight. So it had the move, right? The big strength up, profit taking, shallowing out, tightening up, compressing. If you looked at the volume, let's see if I can pull to a gold futures chart. You can also see how right in here, see how the volume was just, there's little pockets of little dried up volume as it started to pull back. And it broke out. Okay, so that's the daily chart. Now here's where the fractal thing comes into play. Fractals say, okay, well, what if I saw this on a different time frame? So we're going to step out to a weekly chart. And if we step out to a weekly chart, what we then notice is that you've got this big breakout happening. I'll make this one say yellow on a much larger time frame. So it's still deepening here, but then it comes up and it tightens and it shallows. So see how they're both forming this breakout kind of right in here. The daily over about a 10 to 12 month period, the weekly chart over about a 4-year period. And then this one was crazy because you step all the way out to a monthly chart. And now we're looking at 13 years of this formation. And we'll make this one say blue, where once again, we had the big run higher, leading to this large multi-year shallowing, tightening breakout. All of this led to a breakout above the $2,000 mark, right? And so this is the concept of fractals, where you see a similar pattern on multiple time frames, and these tend to be the strongest. As we know, from here, gold has led, this is started this historic rally in gold, all from that $2,000 breakout. That was the best point to buy gold in the last 15 years. It's doubled, which is a huge move for a $30 trillion global commodity market, okay? And so how can we use that for us shorter term? Because it is not that often that we're going to see stocks or commodities with this 14-year breakout setup, right? And so one of the examples I gave on how to take advantage of this was going to like weekly, daily, maybe hourly or 30-minute charts. We're talking about Biohaven. Yeah, it's down pre-market. Must be some news there. So when we look at a stock like Regetti, this has been a monster. Okay, this is one of the big quantum computing stocks. If we put it in logarithmic scale, you can see just this big shallowing breakout over in here in early 2024. Notice how it was deepening, and then got nice and tight right up against here. See that? And then it broke out and made a huge run. And it did something kind of similar. This one didn't really go too far. Similar, so went up a little. This one went out in a big way. But the thing is, we're looking at it in a log scale. These are volatile stocks. Even this little breakout over in here, you would have been risking like 18 to 20%. So how can we get in tight? And one thing you can do with these is come in and go to a 30-minute or an hourly chart. And when we look at Regetti, now it may not be 100% perfect, but this breakout pattern is something we look for in both after a stock runs higher and then needs to compress and shallow and tighten, absorb the flow and get ready to break out again. But we see the same thing after it comes down, because the same concept is true. It needs to absorb supply. Listen, the stock market is buyers and sellers. It operates on the law of supply and demand. And so until everyone who wants to sell, or at least when the large amount of people that are trying to get out are out of the way, the stock cannot go higher. If there are more people trying to sell something than buy it, if there are more shares for sale than trying to be bought, it's going to go down and vice versa. And if we, go back, for example, and look at our big winners. I mean, if we go look at SMR, look at some of these other big ones we made. Look, we bought these here in April in this breakout. We bought them right here. And this was not luck. It was the fact that this stock had been clearly a mover, went from 7 to 30 in 2 months, and then the tariffs hit and the thing got whacked. It fell 62%. That's massive amounts of selling. And so until those sellers are done selling, the stock cannot go higher. So once they are done, okay, there's some buying stepping in, and then less selling and buying stepping in, and less selling and less selling. See how it's tightening up? That's the supply being absorbed for the market. That's the buyers stepping in and finally beginning to overwhelm the sellers. And so once it breaks out through there, that's when you want to get in. And so to take that back to Regetti, again, on the daily chart, oops, sorry about that. On this daily chart, look, it's pulled back from its highs, unsurprisingly. It's about a 40% drop, but it is starting to shallow. But if we go to your 30-minute chart, you can see that after the big dip here from 58, notice how we're beginning to see those signs of shallowing here and tightening up. And so I went ahead and bought this thing on Friday, basically at the exact same price you can get it right now. I'm not ahead of anybody, but you can buy it in here. And listen, is this a 90% win ratio trade? Absolutely not. But here's the reason it's so nice using these fractals. If I do this on a daily chart, okay, if I'm buying, if I want to say, it's not a very long, it's 1, 2, 3, 4, 5, 6, 7, 8, 9. It's like 10 days in here. Okay. If I were to buy it here on a breakout to the highs of the last 2 weeks, where's my stop loss? If it's me, I want it right down in here. I like to have my stop at the recent swing low. In other words, this last few tightening cycle, I want to get beneath the low of that. Ideally, I'd like it down here, but I know that's too far. Well, this is not a Walmart or a Johnson & Johnson. This is a volatile stock. And so if I buy here and I put my stop loss there, I'm risking about 18%. That's a little rich for my blood. I'm not, I don't risk 18% on trades. But if I go in here to a 30-minute chart and I'm able to buy in here really tight, and I can move my stop loss up just beneath this swing low right here. And again, this is that structure we're buying in, and I'm buying right here. Well, what am I risking now? Instead of risking 18%, I'm only risking like 5. And so I'm willing to risk 5% to get into a leading stock in one of the leading groups in a record strong bull market, like 5% all day. And plus, if I'm wrong, okay, I live to fight another day. I'll take a 5% lick and move on. But I can try this 3 times and still have less risk on the table than I would if I bought off the daily chart. So when you have a stock like Regetti, like one of these others that is making, 15, 20% swings, like it's following the pattern. It's consolidating and tightening, but instead of the pullbacks going from 20 to 15 to 10 to 5, they're going from 40 to 30 to 20. Well, that's still, at least for me, more than I want to risk. I rarely risk more than 10% on a trade. And so if I can get in here, I can take a good size position. If I'm wrong, I'll take a 5% lick. It's not the end of the world, and I'll move on. And so I think Regetti is buyable right here for those asking. I think you buy it right here at the open. I think you put a stop right here at 41.60. I just bought a couple hundred shares to kind of show you what I'm trying to do. I'm actually trying out a new account, and I've only sent 10 grand over in here. But you can see, like, I bought it right here. And I kind of stupidly bought it right into the close on Friday. If this was a larger size position, I obviously wouldn't take, I wouldn't take a big position into the close of the weekend because anything can happen. You get whacked like that. But Yeah, it's right here where it's set to open today. I mean, you can buy it at the exact same price on the open here in about 7 minutes. You can put a stop right there. I've got mine at 41 and a half. And you're only going to have, what do we have? What's our risk here? 6% risk. And I'm more than comfortable with that. Okay. So again, the quantum stocks, you can see it up here as a leading performer for 2 months. It used to be the top of all these lists. It has pulled back just a little bit. If we look at the ETF, you can see it's not that it's fallen apart. It's still at its highs. It's just been consolidating. I mean, it made this, whoops, I'm sorry. It's not the right chart. It's still at the highs, but like it made this big run. And then pretty much since the beginning of October, it's just kind of been consolidated. This is what stocks do. It's what markets do. It's what gold does. Like it makes big runs, and then they consolidate and digest. It makes a run, it consolidates and digests. That's part of it. So, I'm not shocked that it is not the leading group in all these character on all these time frames right now, because it's currently just coming out of consolidation. But when you've got an entire sector, not a stock, an entire sector of stocks that is up 83% in 7 months. I mean, that's a ton of strength. And it's up here making new highs. It's very similar with the nuclear space, right? I mean, the nuclear sector, this is NLR, is up 137%. Now, it did pull back. It's got a little overcooked. So you're seeing some of the same action, but it tends to make big runs, consolidate, big runs, and it's probably going to do something like this. And if it's going to continue, it'll break out higher. If the run of nuclear is over, it's probably going to break down below here, and it's might be the end of the road for nuclear for the near term. If you look at the gold mining sector, GDX, similar thing here, big run. And look, this pattern will work in crypto. It'll work in stocks. It works in ETFs because it's just visualizing the law of supply and demand. It's allowing the sellers out of the way. It's consolidating, compressing, absorbing the supply. And once it is concentrated, it's then free to run higher. And so what I'd like to see in GDX, and I'm hoping we get, is, something kind of like this over the next few weeks. Or maybe this, does this. I don't know. But some level of, okay, it's gone as far as it wants to go. It's going to tighten up, consolidate, and get ready for a run higher. I mean, these can't go straight up forever. People do, Ross, you said gold's the way to go. It's down 10%. I'm like, well, yeah, it's still up 90% from where I told you to get in a year and a half ago. Like, this is not normal that it's up every single day for 75 days straight. Like, that's why we want a stock, an industry, a commodity to consolidate, to absorb the sellers. Because when you go too far, too fast with no selling, as soon as they start getting out, it's going to crash. Everybody's scared to protect their profits. And so that's why you get the dot-com bubble. That's why you get these crazy liquidation events in crypto, because when everybody's levered to the hilt, it's been going up for 3, 6, 9, 12 months straight. As soon as it starts to weaken, everybody's going to panic. So despite what people think and what a lot of people believe is just going to go up every single day, every week, it needs to stair-step its way. There needs to be pullbacks. Listen, we had a 11% drop in Bitcoin, and it wiped out 160 million accounts. Maybe it was 16 million. I forget. Millions of accounts. Billions of dollars were wiped out. On an 11% dip, do you have any idea the kind of leverage you have to be using to get wiped out to zero on an 11% drop? You have to be levered at 10 to 1. For every 100 grand you have in your accounts, you own $1 million worth of Bitcoin. Heads up, you deserve to be wiped out. And take that for what you will. I don't care if that sounds mean. If you are so leveraged that a 10% drop takes you out, you don't deserve to be making 10 times the move up. But that's how over-concentrated it was. That's how leveraged. And it's just not healthy, and it's not sustainable. So we need to consolidate. We need drops. We need to knock the froth off the top. Otherwise, you're going to get much, much, much bigger crashes when it finally turns down. The Biohaven sector, BIIB is a group. Yeah, it's a little more volatile, but it is looking good. I don't know why it made that big dip on Thursday. Must have been a big name that dropped on earnings. Um, it's trying though. I mean, you see, it's been in a downtrend for a pretty good ways here. I mean, from just over the last 2 years, the entire sector fell by 65%. Now it bottomed in April and everything else, but it hasn't really taken legs like the big leading areas. But if we just sort of look at this, let's go to like a weekly chart. And most of you guys at this point are probably familiar with the 4 stages of the stock cycle. It's finally come down. You want to see it form what we call a rounded bottom. You want it to kind of come in and sort of tighten up and shallow out here. And so if it can get through here on some decent volume, which we're getting some weeks of good size volume, see big volume that week, last week coming in here. If we start to see some good movement, that could be the start of a new uptrend in biotech. And look, it's probably going to take this sector up 40, 50, potentially 100% higher, which means some of the biotech stocks are going to go up 3 and 4 and 500%. So we'll start building a biotech list of the best names in there. Nano nuclear. I don't know why I'm looking at this. Pretty choppy. Gold backed crypto that allows you to buy gold in smaller increments. I mean, you can buy gold in small increments now. I don't know much about gold backed crypto. Gold backed crypto, I guess I can see a thing for it. Just seems more complicated than it needs to be. Like, listen, I'm going to anger a lot of people when I say this, okay? I'm not a big crypto guy. And it's not that I don't think blockchain is great. It's not that I don't think the idea is great, but the whole idea of a safe haven asset, a store of value protecting you in case of emergency, is that it protects you in case of emergency. If the power's out and all your money's in crypto, you have no crypto. If the internet goes down, you have no crypto. That to me, if you put it in cold storage and you drop your thumbnail, your thumb drive in the toilet, all your money's wiped out. That to me is not something I'm comfortable with. Gold is physical. They've pulled gold off the bottom of the ocean. It's been there for 500 years. It isn't even tarnished. So that's the reason it has been a currency metal for thousands of years. I get the case with Bitcoin. It does make sense. I like the idea of a blockchain, but between those risk things and the fact that there has never been, I've said this before, there's never been a government in the history of the world that has allowed someone else to compete with their control of the money supply. And the reason that crypto's been allowed to run is, number one, we have a very pro-crypto administration whose kids and son-in-law and everybody else is knee-deep in crypto, but no one uses it as currency. As soon as you and I start getting our salary in Bitcoin, as soon as I pay you to build a pool at my house by sending crypto that can't be traced, tracked, or taxed, it's going to be banned overnight. And so, for those reasons, maybe I'm wrong. I hope I am wrong. Either way, that's my case on gold over crypto. So if you're into gold, I don't know why you'd want to go gold back crypto. It just seems a little complex. All right, what do we got here? Market's open. Let's see, what's Regetti doing? All right, so it's holding right in here. Listen, I think it's viable here. So I've taken a small stab at Regetti. Now I'm working a very tight stop. Okay, I'm just buying this little move in here. Stop loss down here at 41.5. Maybe it runs, maybe it doesn't. Again, it's just a 5 or 6% risk. But I'm just really trying to illustrate that idea of fractals. Let's look at some of the other areas of the market. It looks like a lot of stuff's a bit weak this morning. Cypher has just been a monster. This thing just won't quit. You can see the breakout pattern off the low, and it just has not looked back ever since. Cores continues to rip. Galaxy well, it's not really ripping. Clean Spark's holding in there. All right, so nuclear is kind of softening this morning. Quantum so far is pretty much flat. Metal space, a couple of these Coyers. Yeah, see, Coyer might be. This is what happens. Like Coyer mining went from $5 to 24 in 5 months, quadrupled. It's due a pullback. The reason I like buying at these breakout areas is when it breaks out, it's due a run up. It's been consolidating for weeks or months. It's getting out above there. The volume is increasing. The supply is out of the way. Like, odds are it's ready to go. The problem with chasing stocks is it's like, yeah, it is up 170% in the last 10 weeks. It is due a pullback. So that's why I don't like chasing these things. It looked high here and it kept going higher, but it looked high here and it's getting whacked. AI is holding up. Nvidia up here. This will be a monstrous AI bubble eventually. When you got companies, with trillion-dollar spending obligations, and it's become this revolving door with Palantir, Nvidia, and all these guys just basically lending money to one another to buy their own products and juice. It's getting a little crazy, but until the momentum stalls, we stay long. VTYX, let's look at a couple of stocks here. Yeah, VTYX is ripping. That's a big one. Mid cap stock doubled over the last 2 weeks. What a monster. Circular financing. That's right. Yep. That's exactly right. You think GDX is entering stage 3? All right. Well, it's on its 50-day moving average. So the stock needs to blow through and then close goodly below its 50-day moving average to start stage 3. I don't think we're there yet. It did have a couple of decent weekly drops. I'm with you, but even from peak to trough, it's only about a 20% drop. I don't think it could be the beginning, but it's still currently holding at its 50-day. Usually stage 3, it's going to just blow below it and stay below it. That's usually the start of stage 3. QBTS or Regetti, both of them look almost identical here. QBTS. Yeah, very similar action. And this is, QBTS has been another great example of these breakouts. So it comes down, it tightens up, it breaks out. It was from 8 to 20 in 3 weeks. You got another big consolidation, tightening up. Oh, not yet ready. Coming back, and then breaks out, and then runs from 20 to 40 in a couple of weeks. I'm trying to tighten up and run again here. It may be ready, it may not. I mean, it could be that it kind of does this and needs to absorb some more supply before running higher. We will see. But so far, it is remaining in structure. And these dips look really bad in regular. Actually, that was a bad dip, 43%. That's pretty extreme. That's further than it should have fallen, honestly. So we'll see what happens. Is MP going to rebound? Let's see. MP looks like it's going the other direction. Yeah, this is not a great looking chart. I mean, if it's going to bounce, this is where it should do it. It's holding here, bounced here, sitting again. I mean, if it does not bounce, and this is surprising because it came higher, nice, good volume. I guess that was sort of a blow off top here. Yeah, a 40% drop in, what's it been? 3 weeks. Usually not a good sign. And this has been a leader. So this could be early signs of weakening. Yeah, MP is not something I want to be in. BIIB is the ETF, is the Biotech. I'm sorry, that's Biogen. XBI, I think. Yeah, XBI is the Biotech ETF. You can see the run there. It's just steadily marching higher. And you can also see signs of like what I'm talking about. So this one, instead of being flat, kind of drifted higher. But notice how the pullbacks went from being 25% to 10.5 to 5.5 to 4.5 to 3.5. See how it's getting tighter and tighter and tighter and kind of forming this, sort of a wedging pattern in here. They may not all look identical, but you want to see the action tightening and tightening and tightening. I mean, that's your signal that supply is being absorbed and the stock is compressing. This is, again, not ideal for me. I mean, I'd want to see, you could draw this a little bit different, I guess. But it didn't do exactly what we want to see. But I just want you to see there's the same characteristics that shallowing move. Earnings coming in on IonQ. Yeah, we are in the middle of earnings season. They're all coming up on earnings. So definitely want to be cognizant of that. In TradingView, it tells you over here in the bottom right how many days till earnings. So IonQ's 2 days out. I think Regetti's a week out. Yeah, next Monday. See, it's pulling. It might stop us out here on this thing. Yeah, it's selling at the open. So listen, I got to stop, eat the swing low. This is where it found support in Friday's trading. Right in here in this kind of 41.5, $42 range. If it's going to bounce, you'd bounce. If not, again, it's 5% risk, 6% risk. Not the end of the world. I only got a couple hundred shares. INTS. Yes, I don't buy crap like this. I mean, this is, the whole company is only worth 30 million. The whole company is worth 30 million. And 2 weeks ago, the whole company was worth 20 million. Like this is a lottery ticket. This is a penny stock. I mean, look, the thing went up 400% in one day and went down 50% the next. This is the last thing I would ever consider buying. Yeah, Biohaven coming back, which is good. I mean, that's typical ping pong action, right? That's what we want to see. This chart's pretty ugly. You want to see that kind of rounding in, and if it's not ready, right? Ideally, I don't want it to do what it just did. But if it's going to dip, look at that. I mean, it gapped down. Let's just show this on a 1 minute chart. It gapped down this morning here, and just immediately they started buying it up. Immediately up 12% in 2 minutes. So that's not a guarantee for what's going to happen the rest of the day. But that is a sign of a stock that is in demand. And so you'll have to see what the news was on this. I don't know. That wasn't earnings. Something gapped it down, but that's, a nice, good reaction to it, bouncing very, very quickly. What do you make of Big Bear AI? Yeah, I like it. I mean, we bought it earlier this year in a breakout back in here. As you can see, we were a bit early, but it did run. I mean, it doubled here for about 2 months. Way too far down. Somehow came. So now it's just kind of all over the place. I don't really have a good read on Big Bear. I mean, a lot of stocks I'll look at and say, I just don't know. I don't see anything. I look at this and say, okay, it's getting murdered. Oh, wait. Okay, there's coming in. It's shallowing, getting a little early. It's tightening up. And that led to a nice double. It broke down again. Big buying, break down. It's just very, very volatile. I don't think the market knows what to make of it right now. And I think it's just getting pushed around on news and rumors. With no serious accumulation, because this stock was being seriously accumulated in a routine way by big institutions, it wouldn't be putting in a 45% drop here and a 35% drop here. When it fell 35% in a week, they would be buying it and pushing it back up. Instead, it's an egg. It's splatted. It's done nothing for 2 weeks. So if I'm guessing, if I had to guess, I'd say Big Bear goes lower. It's just not showing any strength right now. In fact, it's showing the opposite of strength. It's showing that even at a 35% discount, nobody wants the stock. And so it's just not in demand. And if they don't want it, I don't want it. Bit Digital's fine. I think it's still early, but it's trying. Super micro. Yeah, same. It's a bit all over the place in here. Yeah, we got it last year over in here. It was a monster, but I think it's probably still in, albeit a broad one, and kind of a stage one here. Well, I don't know. It's just too wild for me. Like, I want to invest from that just 60% drop, followed by a 100% rally, followed by a 35% drop. Like, it's beginning to tighten up, but it's still very, very broad. SMR similarly. I mean, this has been one of my favorite stocks for the last couple of years. They make small modular reactors designed to power AI data centers. So it's got the nuclear theme, it's got the AI theme. It's specifically catered to the power crisis we're having with these data centers, but it's gotten a little long in the tooth. I mean, you got a stock that went from 12 to 50 in 6 months. Like, that has to be digested. And when a stock is still up here making these kind of drops, 40% in 6 days, like, that doesn't happen to a stock that is being bought day after day and week after week by large institutions building big positions. At best, they're done buying and are riding it. At worst, they're part of the sellers. So again, it's just not in a position. Now, if I owned it from here and I was trailing a big stop, sure, I'd see if it can run, I guess. If you really want to give it room and put a stop down here at 30 and, risk half your top side, yeah. But do I see signs that this stock is coiling up and getting ready to make a run higher? No, I just don't. Is QUBT setting up? Not even close. Um, Now, maybe again, on a very, very short term, if you went to like a, God, I don't know, something, I don't even see it here. I just don't see, like, what do you mean setting up? The stock just fell 46% in 3 weeks. All right. If anything falls 40% in 6 weeks, it's either on the way to fall a lot lower, or you need to start the process of absorbing all that and finding new buyers and tightening up and getting ready to move higher. This is not that, right? It's just not there yet. And what I was saying is, even over here, after these 30 and 35% drops, it took a couple months to absorb that and get ready to run higher. Here it's been a week and a half. After a 45% drop, it's just not where you want to buy. Let's take a look. Looking in the steel sector. Let's see. SLX, that's what it is. So steel sector looking really strong. So let's kind of run through these, see if there's any names that look like they want to go. Now, let's remember these are not huge biotechs. They're not massive tech stocks are going to run. Tinto had a nice little breakout in here. These are not going to double in a month. Vale's coming out of a really nice pattern in here. If you look at, again, just sort of draw you a line to the most of the top of the supply and look for these areas where it tries to come in up. And you see, I mean, look at the volume. It fell off a cliff here. It was tightening up at the end. And then it breaks out, makes a nice little run. Now it's only 20% in about 2 months, but that's a big move for a stock like Vail. Nucor maybe early. Cleveland Cliffs, which we identified back in here, had a nice run, but clearly things have changed there. PKX, we'll try to bring this up. I think the stream is sucking on bandwidth here. Steel Dynamics, yeah, looks very good. I mean, a lot of these broke out around the same time, and you'll see this because this is why it's so important to focus on the right areas of the market and which areas are the strongest. William O'Neill, the founder of Investors Business Daily, found that 50% of a stock's rally, 50% of that comes from the group or sector that stock is in. In other words, the fact that they had good earnings, the fact that they had, big revenue growth or some news is half of it. The other half is just what kind of stock is it? And so what that means is, like when we've seen nuclear and quantum and semis and everything else rip and roar higher, everything in that sector is running, even the bad ones. And so if my team would quit messaging me, if you will focus on the areas that are showing the most strength, you're then fishing from a stocked pond. So steel, everything's done well the last month or so. It likely will continue to do well going forward. Now, is this an area that typically delivers 50 and 80 and 100% gains very quickly? No. They can't scale up that quickly. They're producing a physical product. But TX, ATF are kind of whippy. Commercial metals, you can see it real clear in here. See how the stock just, this one came out a little later than the others, but same type of idea. I mean, just a perfect wedge almost here, breaking out around 3.25. It's up 9-10%. These are just not fast movers in general. This is an earnings move, and even that's only a 20% up day. Well, that's a pretty big day. Yeah, a lot of this is kind of choppy. Now the clean energy space, we've seen nuclear make a really strong run this year. I think what we're beginning to see is nuclear get a bit stretched and them coming to the realization that at least short-term energy demand need for these data centers, it cannot all come from nuclear. It just takes too long to get these nuclear things up to speed, built, operational, approved, everything else. And so they're going to probably end up throwing a kitchen sink at this thing. And so now we're seeing solar start to run as well. And so the entire clean energy sector, I want to say iClean, is that the ETF? Yeah, the Global Clean Energy ETF is having a banner move here. And continues to push higher. So this is another place I want to focus on. Albemarle, the big lithium stock. Yeah, we identified this one as one of our Tuesday trades. It had a nice little 30% move in a month. But yeah, it looks great. Now you're going into earnings on Albemarle. Okay, it's got earnings on Wednesday, so be cautious of that. I usually don't like to buy stocks right into earnings. I will hold them through. So if I bought here and we did this and I've got a 20% profit cushion, sure, I'll hold that. I'll risk my profits on an earnings announcement, but I'm not going to just take a big position going into it, like a bet on it. IMSR, let's see. I mean, this looks absolutely terrible. Absolutely terrible. I would never buy this stock here. It is down 50% in 2 weeks. Like, what about this chart says I'm ready to go higher? And if your reasoning is, well, once upon a time it was at 30, now it's at 15, you are going to lose all of your money in the market. I mean, you might as well just write me a check for it. And I know that sounds bad, but if you keep doing that, I'm telling you right now, if your thought process is, oh, it went up big, now it's down, that's why I'm going to buy, you will lose all of your money in the market. Just stop, because that's how everybody loses it. And you think you're being contrarian. People think they're going, well, I'm buying on a discount. I'm buying when they get cheap. You're not. That's what every retail sucker is doing. Stocks that fall 50% in 8 days, in 7 days, are not, they're getting dumped hand over fist. That is telling you nobody wants this stock, and they're getting out of it as quick as they possibly can. This is the last thing you want to buy. If it is going to go from 10 to 20 to 30 to 300, what it would have done is make this big move and then tighten up and then make another move and then tighten up. It does not fall 50% in a week. Nothing should fall 50% in a week that you should be buying. So do not look for this as a reason to buy a stock. And people hear buy low, sell high, and they make the mistake of going, okay, that means buy low based on where it's been, and I want to sell high. But no, buy low, sell high means buy low compared to where it is going. The accurate statement should be buy high, sell higher. The only time you buy low when a stock is down 40, 50, 60, 70% is after, repeat after me, after the stock has absorbed that selling. Over here, when the sellers are all out of the way, they've tightened up and compressed and volume is decreased and the last big position has been liquidated, then you can think about buying on a turnaround move higher. Not here. Absolutely not here. In fact, I would take the short side of this trade 10 days out of 10. Yeah, Regetti, I think Regetti failed. Let's see. A little 5 minute. Yep, so it broke down there. So it didn't work. Now, are we butthurt about it? Are we down 18%? No, it's a 5% lick. It was worth a shot. We're trading on a 30-minute chart. It's sold out of the open. We don't know what they're going to do out of the open. But again, if we look at our watch list, nuclear is down this morning. Now quantum is all pretty much down, although a couple are holding steady. So this is what happens with these hot sectors, especially nuclear, especially quantum. They either go risk on or risk off almost on a daily basis. And there'll be all of them down big. And these are, again, this is what happens when you get this far extended. Like when you're into stocks that were worth, $10 a few months ago, and now they're 40 or 50, like this cuts both ways. Anything that can go up 300 or 400% in a couple of months can go down 30 or 40, 50 in a couple of months. That's why you want to be careful with them. Now, somebody said gold is cruising, Pat. I bet you're right. Let's see. Yeah, gold's holding up. Now, notice the difference here, okay? Gold, yeah, probably went a little too far too fast. If you put this in log scale and just sort of draw you a line through the bulk of this move, right? What do you notice about what happened here like September and October? Well, it's been kind of a little above, a little below, it's been just sort of riding this. And then look what happened. It kind of went, parabolic. It just advanced a little too far, a little too fast. That's fine. It's not the end of the world. The end of the world would be, oh my God, they're selling gold. Now that would scare the hell out of me. But people saying gold's done, it's all over on a 10% dip after it's up 60% year to date. Are you drunk? That is not a collapse, folks. And I may be wrong on this, but I would bet, in fact, I am betting that 6 months from now, gold will be higher and Bitcoin will probably be lower. Because my entire Twitter feed is a bunch of people with a chart of Bitcoin And I cannot believe they're even allowed to function in society. And their chart of Bitcoin is like, hold on, take it at a log scale. I forget how they even did it. It's something crazy. Like, it's like a 2 point touch. I'm not doing this justice. I forget how they drew it. It's something wild suggesting a higher price, but it's like it's the most basic analysis. And everybody out there saying, oh, Bitcoin's up. The last time gold topped, Bitcoin soared. Like, yeah, one time in 2020, gold topped and Bitcoin soared. It's an entirely different market driven by, government funny money and PPP loans and people stuck in their house, not allowed to bet on sports, gambling on this, a giant wave of retail trading, Robin Hood coming into the works, like all kinds of. That's not the case here. What do you see in Bitcoin? Now, I thought this thing was going to break out back in June, and it did for about 3 days. It had a big run up. It was tightening up in here from 110 to 120, and then it's just done nothing. And since then, what are we seeing? Well, okay, it's supporting the breakout area. That's good. Oh, now it's broken it. Now it comes back up to these highs and failed. Now it's put in a lower high, a lower low, excuse me. Now it's a lower high, and it's probably going to do this. Now, did I use any indicators? Did I use any moving averages? No, but like just look at the volume. Where are the high volume days? Are they up days? Or are they down days? Every big spike is red. Like, Ross, that's oversimplifying it. The hell it is. That's where the big players are. They're dumping this crap. I mean, go to a weekly chart. This was big buying coming in. Weeks of big buying. And it rallied and it rallied, and there was little volume on a pullback. That's fine, consolidating. And then they're starting to sell. And anything can happen. I might be dead wrong on this, and that's okay. I'll eat crow if that happens. But I've looked at a lot of charts in the last 21 years, and this chart tells me we're going lower, not higher. At the very least, we're gonna sit around here for a while. Nothing about this chart is pointing to consistent accumulation and higher prices. Nothing about it. And when all the Twitter accounts and the 0.0001 Bitcoin wallets are the biggest and loudest bulls, that's usually not a good sign. And so take for that what you will. I have a friend here locally. He owns a big trucking company, and he was calling me, and he's long Bitcoin. He's looking at and he got in here, and I told him to sell it at 118. I said, look, man, the breakout didn't happen. It's weakening. It's going down. You got a little short term dip. I would sell it here, and he did. And then a few days later, he said, man, it's at 125. You told me to sell. Well, he called and thanked me this weekend because I saved him a lot of money. He's pretty glad to be out at 117, 118. And I didn't know that'd be near the top. I don't know what's going to happen, but I do know the chart is souring. And so, sure, sometimes you're going to need a chart that looks like this and it just goes to heck. But that's more the exception than the rule. Our job is not to predict every single move and look at any single stock and say it's going to be higher, it's going to be lower, it's going to be up, it's going to be down. You're just looking for the ones where you do have an edge. You're just looking for the stocks that are setting up in a situation that historically leads to higher prices, where you can risk less than you're trying to make. APLD looks great for whoever asked. It's ripping higher. Look at this. I mean, you've got a stock that tripled in 36 days. And then it starts to roll over. Oh, here we go. What does it do? It falls 25%, bounce back, and it's holding in here. So I'm not saying it's definitely going to go higher, but nothing about this to me says the run is over. You're not seeing big, heavy selling. You're not seeing dips that did and then just sitting here where no one wants to buy it. It pulled back 20% and they bought it. And they bought it back in here and it's tightening up. It needs to consolidate. It needs to absorb its supply. The damn thing's up like 700% since April. And if we look at it in log scale, I mean, and log scale just means every inch is the same percentage. So instead of every inch being $10 or $20 or 50 or whatever, each inch is the same percentage. And so when you're looking at a stock that's made a big move, put it in log scale. If you're looking at 5 years of data, go to log scale. It's going to smooth it out. But does anything about that look scary? Sure doesn't to me. So I think APLD looks great. The PALL ETF, is that physical palladium? Yeah, I mean It as well, you know, I talked about this in here. It was breaking out. It continued to push higher. It's pulled back a bit. That's not surprising. I mean, the entire metal went up 50% in, what is that, 6 weeks? You know, it's going to pull back a bit. This was just a shooting star. So it's down 12, 13%. Palladium is more volatile than gold, a little less volatile than silver. In fact, if we look at, you know, maybe all three of them in here, let's see. Pretty similar. Let me just make these. Tell you what, let's do this. I'll put it on the ETFs. This is palladium. We'll add silver. And I'll make it silver so you can. There we go. Silver. And then we'll put gold on here. It is important to do every once in a while. Just see what the behavior is of the instrument you're looking at. Like, am I in the wild one or am I in the quiet one? You know, we'll make this yellow for gold. Okay. So, you know, they're all kind of moving together for the most part. Palladium's obviously a bit late to the party. It has underperformed. You know, it didn't start rallying until really a few months ago. So we zoom in here to when it started moving. It's moving pretty close to silver. You know, it's just a bit wild. I mean, gold is the most steady one in here. Silver's a bit, the swings are a bit wider. You know, this was a 12% drop in here, but it's also up 75% over the same period that gold's up 35. That palladium is up 50. So, like I said, it's kind of silver than palladium than gold in terms of volatility, which means you're going to make more on the way up in something like a silver and a good rally. You're going to lose more on the way down. Okay. Let's see. Other questions. I know we're over the time here. We'll go ahead and conclude this shortly. When you enter a position, how do you decide on size? So, Robert, I'm generally looking at every position in terms of total account risk. Okay. So let's take, let's pretend we were buying palladium here. Okay. It's not a perfect setup. Let's just pretend we were. Now this is an ETF. So let's say we're going to buy a breakout here. Okay. On a move through here. And so we're going to buy it like a 135 breakout. And our stop loss, we want it all the way to the swing low, is going to be here. Okay, here's how I do position sizing. So I know that from where I buy to my stop loss, my risk is in this case 8%. All right, let's just map this out. 8% trade risk. So this you can do this in your head. I'm just going to lay it out for you this time. It's not, you don't really have to do any calculations. So 8% trade risk. Okay. General rule of thumb, especially if you're newer to trading, is you never want to risk more than 1% of your account per trade. You may go to 1.5 when conditions are good and you're having a 30, 40, 50% year. When you've been doing this for a while and you're up big, some guys will go to 2%. But just as a simple rule, start at 1%. Okay, so let's say I'm trading a $50,000 account. Okay, I want 1% account risk per trade, which comes out to $500 risk per trade, right? Any questions on that? Makes sense? $50,000 account, I'll risk 1% of that on any one trade, which is $500. So I'm risking 8% on this. That 8% needs to be no more than $500. So all you got to do is say, what trade size can I do where 8% is $500? And the simple way to do that is you take 500 divided by 0.08. So that's, 8% risk. Basically, it's 8% of what is 500. And so 500 divided by 8% means I would be willing to put up to $6,250 in this trade. And on a $50,000 account, that's going to be 12.5% of my account. Now, again, the reason I do this on a per account risk basis is If I get into a stock and it's wild and it's swinging, I'm like, I can't get away with 8%. I need to risk 15 to 18%, but this is a mover. I want to give this sucker room. I believe in this. It's a weekly chart, whatever it is. It's like, okay, I can still take that trade, but I'll probably end up putting more like 3 grand into it. It's still going to be 1% of my account at risk. On the other side of that coin, let's say this chart of palladium we're trying to buy here really tightens up and gets ready to break out. I'm buying the same breakout at 135. Okay, this is an important exercise. So stay with me here for just a second. I'm still buying the breakout above 135, but I'm no longer risking all this. In fact, I'm bringing my stop loss up to here. That's as far as I need to let it go. All right, well, now instead of risking 8%, you're risking it's 3.5. Okay, so what is 3.5? If I'm only risking 3.5, same $500 risk, I can put a lot more money into this trade. I can put $14,285 in. So instead of putting, 12% of my account, I've got almost 30% of my account, 28.5. And most people say, I'd never put a third of my account in one trade. You would if you're only risking 3.5%. And the beauty of this is, this is why one of the reasons I love these when they get really tight and compressed is like, if I get it right on a small risk, man, if this thing runs 30, 40, 50 plus percent, and I got a third of my account in this sucker, that's going to move the needle. My whole account's going to go up 10 or 20%. And so it forces you, or at least encourages you, to look for these really clean setups. These ones got, what about this one? I'm like, all right, you want to risk 30%? You believe in it that strongly? Fine. You're not getting much money into the stock. And so it better double or triple, or else your, 5% account position isn't going to really do much for you anyway. Oh, David. Okay. You were a Minervini disciple, because at least that's some of the terminology he uses. Minervini's one of the best ever done it. Low handled sheet, mid handled sheet. Yeah, absolutely, David, for sure. And in fact, we did that back in April with great success on some of these moves, like in OKLO and a couple of others, where we actually, if I can zoom in on this, instead of waiting that, we bought like some of these down in here. But we don't have, some of you guys are like, what are they talking about? It's just sort of advanced entry technique and stuff. Had a sound hound look. Sound's been a monster force. It is, currently pulling back a bit. Still, for the most part, kind of holding this little uptrend over in here. Honestly, it just looks like it's in a hurry up and wait mode going into earnings. And the big hint there is the volume. It's just drying up. So nobody's really, it is pulling back, but it's pulling back on light volume, just far less scary than pulling back on heavy volume. I think it's just kind of coming back in here. It wasn't quite ready and tightening up. So it's sort of in a price acceptance or consolidation mode versus a price discovery mode in there. All right. Okay, tell you what, we're about 10 minutes over time. Let's go ahead and end the session here. We'll be back next Monday at the same time. I hope you guys got something out of this. The recording, if you're watching this on YouTube, feel free to put your questions down there. I do my best to try to answer these. If you're a member of us joining us over on Zoom, please feel free to reach out if you have any questions. And until next week, you guys have a good one, and I will see you then.